All right, hey traders, Sam here from TradeDevils.com and TradeDevils-Indicators.com. So I want to do a little follow-up video here. Many of you have taken advantage of the trial on the new indicator that we just released, the market structure indicator, or are trialing others. And I thought this might be a good opportunity. We're going to just review the most recent week. A lot of volatility and some interesting examples here that we will certainly walk through, and I think that can be helpful in terms of what to look for with regards to setup. And that's really in the context of whether you're applying this as a standalone technical approach, which certainly it lends itself to, or if you're adding this into some of the work that you're already doing, where I think it can only augment how you're approaching the market. So with that said, now of course some of you are here because you saw the email that we sent out referencing the little holiday promo that we're going to offer this weekend. So we'll run this through Sunday night. So it's just a little discounting here. So on one indicator we'll give you 20% off, and it's important that you use these codes. If you got the email, of course you'll have those. Two indicators, we're giving you 25% off, and of course, again, you got to use these codes exact. Oh, pardon me here. I got to fix this one. You got to do it exactly without a space. Get you back there. Okay, so I don't want to get you screwed up here. So if you're doing 3 or more, right? Any indicator, it doesn't have to be the new indicator. It's just, and this is true with any of these, any indicator that you're interested in. These discounts will apply, but 3 or more. So for those of you, we have many people that will buy complete packages, templates. So this would be a good opportunity to take advantage of that and get some discounting as well. So that will again run for the next couple of days. And if you're not on our email list, of course, right, you get this here. But now if you're watching this 3 weeks from now, those codes will no longer be active. So just a reminder, it's just going to run for the weekend. So with that said, let me we'll get rid of that here. Assuming you guys can pause the video. So let's get that out of here and let's bring back our charts. So I'm going to go over a couple of, we're going to do some market replay. We will do that so we can show some setups as they're happening. But before we do that, I just wanted to go over some things that I think will be important to you, just kind of big picture here with the intention of increasing your win rate and perhaps reducing some of the confusion about where the trend lies. So in order to do that, it's very important that you keep somehow, some way that you keep track of the bigger picture, or the larger degree, or the higher time frame. That's what I'm trying to say. So this is exactly how I set my windows up, if you will, or a template. It's important that you have a higher time frame, a mid-level, and then whatever you're using for execution. Now, for me, I like a 60, a 15, and then here, this can be anywhere from 1 minute to 1 to a 5 minute here, but I tend to stay, for execution, I'm more likely be between a 1 and a 3. Now, some people have applied this to tick charts and are having great success. It certainly, nothing would change there. So if you like, if you want to see more swing definition here, I mean, you can go down to a 512, right? You're going to get all sorts of swing. So it's just a matter of personal preference. But I would tell you, particularly if you're in the trial process, this would be a good place to start. And I just want to emphasize how important it is to keep an eye on the big picture here, so that ultimately what we're trying to do is look for opportunities where we can be in sync with the higher, where all 3 time frames can be in sync. Now that changes throughout the course of the day, because certainly on the smaller time frames, uptrend to downtrend can be changing multiple times through the course of the day. You can see that as well in the 15. You will see it on the 60, but it's less common. So by getting clarity on where the higher time frame trend is, we can look for those opportunities where we can get at least 2 out of 3 have defined the trend in the same direction. So whatever retracement, whether it be supply or demand zone that you're approaching, you can look at that with a little bit more confidence and conviction, because you're in line with the higher time frame trends. So it's probably easier to show you than to speak of it. So I just want to show you some 60-minute charts from this past week. Now, as I said, I'm recording this on Saturday the 16th, so I'm just going to use as I always do, I'm just going to use the most recent week's data. So I only have 4 days to use since we were closed on Friday. So let's just go back and just briefly here on the 60 minutes. So I'll show you a couple of things and why this is so important. So I'm going to start with crude here, because these are some striking examples here. So let me just bring this back up here. So this is, what have I got here? I think 30 days of crude data here. Well, let's see how I got there. Yeah, that's about right. Let's reset here. So 30 days of crude data. Now, as you look at that right now, so I, of course, just to be sure that you're aware of this. So this is our toolbar up here. This is the Trade Devils toolbar. I'm going to grab things from that right through the course of the video. I include that. I don't have anything on here other than a 200 EMA. Now I have the indicator applied. I just haven't turned it on yet. So and I do that deliberately. So if you're looking at this chart here, and I said to you, okay, where's the trend? What is the trend? Well, that's a loaded question, because it ultimately depends on what section of the chart are we talking about. So it would be very easy to look at this and say, okay, well the trend is down. Right? So if I grab something, here's a swing, here's a retracement, right? It's internal, right? So the assumption would be this is a retracement of this entire move, and it wouldn't be unreasonable to assume that retracement, well, target would be that low, that we're in the process of a bear market here, or a bear trend on the 60-minute. Now, right, you could then just as quickly say, well, wait a minute, I'm just looking at that 200 EMA, which I know is a good reference for trend. And we know institutions use that. We know a lot of algorithms will key off of that. So here we're above the 200. So is the trend not higher here? You'd be accurate, right? That's not inaccurate. So what I'm trying to get to is, how do we define these trends? I think the big appeal to the market structure approach, and whether you're calling it market structure or smart money concepts, what attracted me to it right off the bat was how binary it is. We can be absolutely definitive about where the trend is at this moment in time. So on a 60-minute, if I turn the indicator on, well, you see we're in the process. We have transitioned from this pivot high here down through a downtrend, right? It's not hard to spot that. So here's one break of structure, another break of structure, breaks of structure, all the way down. Now we put in a pivot low here. Now all of a sudden I've got multiple breaks of structure here. So it's very clear the transition from downtrend to uptrend. Now, of course, that could switch easily, right? If indeed what's happening here is a swing and a retracement, well, for that trend to change, well, there's got to be breaks of structure for that to change at this degree. Starting with the internal low here has got to break, and then perhaps a retrace, and then we get that trend change from down to up to down. Right now, as we look at this, obviously it's an uptrend because of multiple breaks of structure on the climb higher. Now, the reason this is so important is because as we're viewing where the opportunities might be, and again, I would encourage you to consistently reference what's happening on the 60 as well as the 15 and whatever your execution time frame is, to be aware of where the supply and demand zones are, as well as how is the trend moving at that moment in time. So I'm going to do two things here. So if I turn on the supply demand zones, well, first thing, just a reminder, by default, mine is set to only show the wicks of the zone. And I do that deliberately because often, particularly out at a 60-minute, you may get very large candles to where if you're highlighting the entire candle, you can get you can get massive blocks like this, where it really is not offering you any benefit because they're so wide. So I have it set to, and I referenced this in some of the early videos, I have it set to only show me the wick, and it's almost like just a notification. Okay, there's a supply or a demand zone here. Now, if I want to dig in a little bit further, well, I can always go to that. This being a good example, here I could just draw this across, right, and I can see that that's where it is. So here, what's identified on the chart through the indicator is just the wick, but I can just look at it and say, oh, okay, well, that's likely where this little up here is the last up before down. So here it's defining that little up here, so it's using that wick. Now here we get, right, we talked about this in the last set of videos. Here I've got a wick that comes through, but I don't get a close that comes through, right? So as we come over here, now you see it referenced here just being in wick does just fine here. So at the close we tagged it, and then you see we've already, that's bigger than you think, right? This is a 60-minute chart. From tagging that to where we went down, that's $1,600, right? So again, obviously, right on the 60-minute, a move that looks like, oh, it looks like, well, we got a couple $100 there, very different. So you got to keep some perspective on that. But this is, I mean, there it is, right? We come right into the supply zone, you get a reaction. Same thing down here. Now, of course, keep in mind that what's on the chart is these are all the supply and demand zones that have not yet broken. Right, there would have been multiples in here, up and down, and of course some hold, some break, or the market goes sideways. So recognize that what you see on the chart is what's unbroken. So we have support down here, we have supply up here, or I should say demand down here and supply up here. Now before we leave this here, just in the spirit of which is where I'm headed, which is how to combine this with some of the things that you're already doing. It's hard for me not to digress in this, but let me just take this off for a second. Now, and again, this would be in the spirit of combining tools, right? So we don't want to abandon everything we know about how the market moves, because we're now incorporating some market structure and some different ways to interpret supply and demand zones. So just to keep this at the forefront of your mind's eye, let me just turn this on. I'm going to do this in all three markets, right? So and I don't do this. I'm not really trying to cross promote here. I'm just trying to be sure that you haven't forgotten about this. And if you're not familiar with this, you need to stop this video right here and go back to our playlist on YouTube and watch the measured move or even the auto fibs. Watch any of those videos about this. What I'm about to show you is the dominant algorithm in the market. Now, some of you that have followed our material, whether it be on our main content, where the focus is more off of TradingView as the trading platform, or material that you've seen here on Ninja, you'll know this is an indicator we use, and perhaps you've seen some of my training content on how dominant this indicator is. This is absolutely, without question, the dominant algorithm in the market for us as retail traders, because it's the one that we can spot, right? It leaves footprints. So I'm just going to turn this here on a 60-minute. This is just the last one we got here, a couple of weeks. Just again, not to digress, or it's easy for me to digress into this, but look how consistent this is at these pivots. Swing, retrace to the 50. There's the target, swing, golden zone, target, target. Here's a stack of golden zones. So you see all of this. So these are things that we've been teaching and training and talking about here for years now. So let's not forget that. But what I want you to see is how you can benefit from the combination of the measured move indicator and just keeping track of what's happening here with the market structure. So let me turn this back on here. So now we see all the breaks of structure here. Now it starts to get a little complicated, which is why we have can get a little convoluted in there, which is why we have an on-off here for the measured moves. But now notice if I turn the supply and demand zones on. So as we look here, now you can see this, right? So here as we sit, now you can't see what would have been happening there on a smaller time frame, but essentially there's a push away, there's a retrace to it, and then it's the same thing's happening here. See it again. I know. I'm not going to digress here, but it's very easy for me to get, because this is so powerful. I feel like it would be a disservice if you aren't familiar with this, right? And then we retrace to the 50. Here's the target, within a tick or two. There's the break of structure. Now we come back to a 50, go down to the target. Here's the next one, gets its target. Now look where we finished the week. So as you're looking at that, so just so you're clear on that, let me just draw that so you are clear on this, and then how this other material fits in with that. So look where we finished the week, right at the golden zone. So after seeing how many times that golden zone is hit, that algorithm it fires either at the 50 or at the golden zone. As we finish the week here, we are a couple of ticks into the golden zone at a supply zone. So this is actually, the reason I show you this is kind of where I'm headed here. We can see that the trend is up here, right, because of the breaks of structure here. But we've just hit one of the most significant technical pivots we could possibly hit, which is the swing high to swing low, the dominant high to the dominant low. We've just hit a golden zone. So now this is kind of a conundrum that every trader has to deal with here. We can see based on the structure that we're in an uptrend. But when I started the video, I said, well, now it would be easy to think swing, retrace, right? Now we know that has a target down here at below 88, right, at 87.38. There's an algorithm that fires here that's going to stay short until it gets that target, or it gets stopped out on the other side of the 65, right? So which would be at the pivot high of that supply zone. So I'm just trying to get you to keep in mind that there's a bigger picture that's happening here, and to ignore all of these would be, I think would be, well, it would be lost opportunity. So keep that in mind on the big picture here. Now, whether or not, if you're a day trader, whether you can take a crude contract, through some of these swings, well, maybe not a full size, right? There's always the options or micros, so it might give you some more staying power here, and you might make it more comfortable taking something like crude overnight, or you hedge it in the options market. There's a lot of different ways you can do it. Again, here I am digressing, but I need you to be aware that when you're out here looking at the 60, let's not just only look at breaks of structure. Let's be aware of where the dominant algo is as well, right? And you can see how dominant that is. And you might say, well, okay, well, that's good in crude. Well, of course, you know I'm going to do the exact same thing in the other markets. But as we sit here, here's the conundrum, right? So the 60-minute is in an uptrend. Do I want to take that trade? Well, we'll look at that and how you might be able to approach that. But the major point I'm trying to make here is you have to have an awareness that if you take that short there, that is a counter trend trade. That doesn't mean you couldn't make some good money there, but I want you to have an awareness that that's counter trend. We're above the 200 EMA. The swing structure is all bullish, yet you're sitting in perhaps the highest probability location for a sale as we have just approached that golden zone. Now, it's tricky that it did that on a Thursday afternoon before going into a holiday weekend. I don't know if anybody would want to be holding that, over the long weekend. But I mean, actually, as we just looked, if I zoom in there, there's actually already been a pretty nice trade reaction. If I can get it up here, right? So here's just getting into it. Now, if I turn that on, look what we're doing, right? Just tapping into the supply zone. And again, I know it's a 60-minute, right? So let's assume you're not going to get the tick high, but what did we do there? There's $1,450 just off the reaction. So keep that in mind. Now we'll look at how to apply that and how to reconcile the difference between what's happening on the 60-minute and then the intermediate times, because you could have an uptrend on the 60, a downtrend on the 15, and a downtrend on the 1 or the 3, or various combinations. So you need to keep an awareness of that so you know where these critical pivots are. Okay, with that said, let me just quickly here spin around just to make the point here, because again, I think this is important on a week like this where we've had so much volatility. So let me just take this off. Okay, so it's kind of the same question. Now, this is a 60-minute here, right? Same thing. I think I've got 30 days of data. Is there confusion, right, about where the trend is, right? I mean, here, this one's much easier, so we can look uptrend, downtrend. All right, we're well below the look at this. Look, right, this is why you want to keep the 200 at all times, right? Because the whales keep an eye on it, right? And a lot of algorithms will key off of it as well. So here, coming up to tag the 200 before we roll over, right? Just don't lose track of the 200. Right, keep it somewhere and keep a 60. So as I was showing you before, if you're limited on screen space, you can do something like this, where I've got a 60, a 15, and your execution time frame over here. That way you can always, at a glance, I mean, you can do it through tabs, but if you have the screen space, this would be optimal. Right? You can quickly go back and forth. Let's go back to the 60 here, because I'm going to try and wrap this piece of the video up here. So same thing, right? Here we know we're in a downtrend. Now I say that. Now as I say that, let's put this on here. Let's take the zones off first. Okay, how is it we have such conviction? Well, you could say, oh, it's below the 200. But in addition to that, we can see the breaks of structure. We had a little bit. This would have been a counter trend upswing here, because we've got multiple breaks of structure. So you can see even within the larger degree here. If I'm well, I can't bring it over. If I'm right here and I've had if you're here, right, and you get a swing and I get a retrace, right, your assumption wouldn't necessarily be, oh, downtrend. Right, you don't confirm until we get this break here. Now we can see, now we get multiple breaks of structure. So just as you saw in the line drawings, we went through how we're defining trend. With these multiple breaks of structure, we know the trend is now down. Now the 200 EMA just offers you a little benefit. So now, before I turn the supply and demand zones on, we'll focus from this pivot high. Just as I did before, all I'm going to do is turn on the measured move, just to remind you how dominant this is. So if you were looking for indicators to combine with one another, adding the market structure where we're going to find these supply and demand zones, and then the measured move algo indicator, whether you're doing it through auto fibs or the actual measured move indicator, you just have to know where this is, right? You are just, as you've often heard me say, you're trading blind if you don't know where it is. The analogy I like to use is, I don't know if it's the best one, but you are literally walking through a minefield with blinders on if you don't know where this algorithm is. So the first thing, always, where is it? What did it do last, right? Where's Waldo? What did it do last, right? Now, looking at these, right? Do you think this might be important information to have, right? So from the swing here, this is we do see this. You'll get wicks through. I have it set so it only comes off if on a close above. So swing, retrace right to a golden zone. There's the target. Swing right to a 50. There's the target. Swing right to a 50. There's the target. Swing right to a stack of golden zones. Those targets are unmet. They're down below. Retrace back to a 50. Targets below. So I show you that. So now with that acknowledged, if you're seeing this for the first time, that should be blowing your mind, right? If you're not aware of this, you need to stop this video and go watch the measured move indicator so that you understand how dominant this algorithm is. If you were even the slightest bit unsure, hopefully just looking at the last week would give you some ideas. Now I'm going to take that off. Right now let's add the supply demand zones here. Okay, so again, remember I'm looking at wicks only. If I had the full candle on, some of these are going to be very large here. Now, was that problematic to do wicks only? Well, if you were waiting for this retrace from this swing here, we didn't get it, right? And that's often in strong trends at the higher time frames. There will be times like this week where we had such big moves, the retraces may not quite make those critical supply and demand zones. So keep that in mind, and that's where moving from a 60 down to a 15 to 1, 2, 3, 4, 5 minute will help you identify that. But as we look here, well, here this would have been spectacular. Now let me put the measured move indicator back on, right? So as we come back to this golden zone here, as we're in a supply zone here. Now, of course, I'm just using the wick. Do it like that. Well, you would have had wick that went through, but as we come back down, right? There's the target. Makes it back here. Now this would have been just spectacular, right? So I mean, it's a little hard to see out here. I know this, right? So we get, I'm going to just draw it for you. Down we come. Now we come all the way back. Now look what we're doing right there. Not only are we tagging a 50, we're tagging the underside of the 200 EMA as we're into a demand zone. That's the wick. That's how good that is. Now what comes out of there? Right, 6,500. And you got multiple stop. Now, are you going to stay short through all of that? Well, probably not if you're in a couple of full-size contracts, but micros or options, right? It's another way to get some swing benefit. Hopefully, what you're seeing here is the value of doing that. So now this gets a little. This is a particularly good week because look at this swings. It's a downtrend, but look at the size of that move. Let's just put it in dollars and cents so you appreciate that. There's a $4,000 swing up in a downtrend, right? And then immediately 4,000 straight down. Then another, well, I'm just going to approximate here. If that's 4,000, that's going to be about 4,000 up and then straight down. So the volatility that we're seeing here is remarkable. I mean, this is extreme volatility. Anyone who's trading obviously has been experiencing that. And why? Of course, we all know why, right? The market wrestles with changes in interest rate policy. So this volatility is very typical with that in the background, not to mention all the macro madness that's in the background as well. But I'm really making a point out here because this is an easy mistake to make, to get caught up down on the 1 minute and you lose the big picture. So of all the advice I can give you of how to incorporate this into your current trading arsenal, or if you're using this as standalone, you've got to keep perspective of the higher time frames. And what we're looking for are those times when we can get in sync. Small time, medium, and higher time frame can all be in sync for the downtrend. And that's where you're going to see the highest number of the highest win rate, and then you're going to see those extended moves. So I encourage you to always check out here, and I certainly would encourage you to be aware of where that algorithm is. I don't know how anyone trades without an awareness, because if you don't know where it is, you'll buy right into it or sell right into it. So there's a couple of good examples here. Oh, just because it's so dramatic here, let's bring it over in the Nasdaq as well. Let's turn everything off. Oh, what do we got here? Let's turn them all off. All right, so here's the Nasdaq. Oh, and again, these are massive swings, right? So there's almost 8,000 up, 8,000 down, 8,000 up, 8,000 down. Where's the trend? Well, can we be definitive about it? Yeah, we can be definitive about it, right? So if you hear, so the trend is down, right? Where's the 200? All right, so trying to make it easy. Okay, break of structure, break of structure. Now we get into this zone here where this was difficult trading, right? No question about it. You're just because you're in a range, right? Up 7,000, down 7,000, up 7,000, down. really extreme volatility. It's a bit frustrating in a week like this because it's the kind of week where you look at it and you go, well, what's so hard, right? I'll sell it coming in, then I'll buy it, then I'll sell it, then I'll buy it, then I'll sell it. Yeah, I wish that it was that easy. But here we're giving you some tools to try and help identify, okay, when do I want to be a seller? Well, okay, this might be part of that. Okay, I'm in a downtrend. So when I retrace right here, and do you see this? This in the move down here, we've left behind this supply zone. Right now, that's wick only on a 60-minute. We come all the way down. Now I come all the way back to this supply zone. Right? I literally tag the center of it, and I go straight back down. And then, now this is not a break of structure because that's wick only. So look what I do. I come all the way back to the same supply zone where I put in a high. Now this is all tied to this supply zone here, the wick of this bar. Boom, boom. Those are $7,000 swings in the NQ. Now, just to make it a little bit sweeter, make it a little bit easier. Now, look at those supply zones here. Golden zone to the tick as I'm hitting the supply zone for the second time because I already hit it once here. Now, I'm back. Not only am I tagging the supply zone, I'm literally tagging the golden zone, and then look where we go. Here's the target, but here's the break of structure that gets you there. Now I get all these breaks of structure. I'm actually getting second targets here on the algo. I come back here. What do? I'm back to the supply zone at a 50. Straight down. Back to the same supply zone at a 50, straight down. So you look at that and you say, well, okay, well, what was the trend right here? Right, that's an $8,000 up move. What's that trend? Did the trend change here? No, it didn't. Right, but that's an $8,000. I mean, that's a big up day. It did not change the trend, but of course on the smaller time frames it would have, right? You would have been there certainly through all of this. This would have been nothing but uptrend on the smaller time frames. But you got to keep perspective because when it's coming, this is what not only what makes this powerful, but also it takes a little. It takes some time to build the conviction to see this happen, come screaming up here into that supply zone and be able to sell it. Right now, why is that hard? Who's not going to sell it there? Retail, right? They're because they think the market is going to scream higher. But if you look at the risk reward here, that's what I want you to focus on. So if we look at that risk reward, your target is, I mean, there's 10 to 1 from this supply zone here with a stop just on the other side of the supply zone here with your target, right? Never changes. Target is always the prior low. Here's the week low. It's noted on the chart for you. Oh, if I can get this, can I get that to slide? I think I can't. Let's get that way. Yeah, I'll get rid of it. Here's the week low, right? So when we're up here, the target was the low because this is we don't get a new high here. So this maintains. It was here and here. Because we don't get new highs, these stay as week lows. So when we get back into this pocket here where we see these 50s, again, look at the 200, look at the 50s. Where's the supply zone? This is a hard trade to take. Right, but look at the risk reward and what comes out of there. Okay, so there's enough review on that. Okay, so let me pause on that, and then I'm going to pause the video here. We'll come back. We'll go look at some very specific examples. But I wanted to, perhaps I went too long on this, but I just wanted you to really be clear about how important it is to look at the higher time frames, and then we'll look at trying to get in sync with those. So back in a second.